What we're going to be going over here is job order costing for a manufacturing operation. And what we're going to be concentrating on here is this manufacturing overhead for our job orders here. And we want to understand what's included in our manufacturing overhead. And then also we're going to be looking at how we apply this manufacturing overhead to our work in process. And both of these are control accounts here, and they're backed up by subsidiary ledgers. So we've got several questions that we have to look at here. So first off, we're going to have to determine what is included in our manufacturing overhead control account here. And then secondly, how do we calculate that manufacturing overhead? And then thirdly, how do we apply our manufacturing overhead here to our work in process? Okay, so let's just start out here first with our materials. Let's just move up here. So our materials, we're going to have direct materials that we've used here, and those are going to go directly into the work in process. They're going to be credited out of materials account here, and they're going to be debited into our work in process account. But then we have those indirect materials. So they're going to be credited out of our materials control account here, and they're going to go into the manufacturing overhead control account, debited here for the direct materials used. So we would have those amounts here. And then what we have here for, let's move it down to our labor here. So out of our manufacturing payroll account, we would have our direct labor used here. We would credit it out of our manufacturing payroll account and would go into a debit here into our work in process. So direct labor goes directly into work in process, just like direct material did. But what doesn't go into the work in process would be our indirect labor. Indirect labor would be credited out of our manufacturing payroll account, and it would be debited into our manufacturing overhead account. Okay, so what we're going to accumulate here in this manufacturing overhead account for these jobs here is the indirect material used, all our other indirect costs, and our indirect labor that were used. And we're going to come up with, for the period here, we would have accumulated those indirect costs here, and we'll have an actual amount here at the end of the period. But what we do here for applying this overhead, it's going to be applied at some budgeted rate and quantity that we use. So we're going to credit out our manufacturing overhead here based on some budgeted rate here, and that's going to go as a debit into our work in process as an applied manufacturing overhead. So what we want to do is we want to calculate this, see what's included in this total manufacturing overhead account here, and also how we would apply it. So what we have for our manufacturing overhead control, it's really got two components. It's going to have the variable overhead component and a fixed overhead component. And with normal costing here for job order costing, you again have your actual direct materials, actual direct labor, which we already looked at here, moving that from our materials and labor account into the work in process. But then what we have to do is we have to calculate this applied overhead rate here, and that is what we're going to be concentrating on. What is included in this manufacturing overhead, and how do we apply that rate? Okay, so let's go over and let's look at that. Okay, so really we mentioned we're going to have two types of overhead here for our indirect costs. We're going to have the variable overhead, and then we're going to have the fixed overhead component. So let's start with our variable overhead and see what is included in it. It would be our indirect materials, our indirect labor, overtime premiums, repairs and maintenances, utilities, unemployment tax, idle time, FICA taxes, vacations and holidays, pensions, hospitalization insurance. And then what you would do is you're going to calculate a cost for each one of these here, and you're going to total them up, and you're going to come up with a total variable overhead cost. And we're going to come up with $30 here per direct labor hour. So what we would do here, just looking at our first component here, indirect material, it would be off a budgeted amount here. So we would have budgeted, say, $12,000 here in indirect materials for the year here. And in all of our denominator calculations here, we're going to use, it's going to be based on direct labor hours. So we're budgeting a total of 4,800 direct labor hours here for our jobs here for the year. So division here is going to give us a budgeted indirect material rate here at $2.50 per hour. So for indirect materials, we would have, for each direct labor hour here, we'd have to charge off $2.50 for indirect materials. So what you do, you go and do this calculation for each of these components here. You go out and look at each component, take its total budgeted amount here, and then you would divide by those total direct labor hours here, 4,800 hours, and you're going to come up with your values that I'm showing here. You just total those values here, and you're going to come up with a total variable overhead rate here. And that's the variable overhead rate based on each direct labor hour. And you could look at it in this sense too. If you didn't do each of these components, you just take your total variable cost. In this case, our total variable cost, we're looking at 144,000 here, and our total direct labor hours that were budgeted at 4,800 hours, and that'll give you $30 per hour. But again, those are budgeted direct labor hours. But I just show you how you would go about breaking these apart here to determine your total variable overhead rate. Just the important thing is here, note which components are going into the variable overhead portion here for those indirect costs that we're looking at. And that's how you would do it here. Now let's go down here and let's look at our fixed overhead here. Again, the components that would be included in here would be our indirect labor, repairs and maintenance, utilities, unemployment taxes, supervisors' salaries, depreciation, property insurance, property taxes, FICA taxes, vacations and holidays, pensions, hospitalization insurance. Again, you're going to do the same thing here. You're going to figure out budgeted on a per hour direct labor hour basis which each of these are contributing to your fixed overhead here, and you're going to come up with a total fixed overhead cost of $50 per hour. And we'll go through those calculations. But when I went through these lists here, just remember they're not all inclusive. This is just an example of what would be included in typically in your fixed overhead and what we mentioned above in the variable overhead. But this is only a good example of what would be included. It just depends on your operation and what you're accumulating in each of those indirect costs here. So again, just going through our example here, just looking at our indirect labor here. Again, we budgeted for the period or for the year here $24,000 worth. Again, direct labor, we're working off that same total amount here of 4,800 hours. So that's going to give you a budgeted rate here of $5 per hour for indirect labor. So for each direct labor hour, $5 per hour here is being charged to estimated here for your indirect labor. So you go through and you do the same calculation here for each of those components, and then you would add each of those up, and then you're going to come up with a total fixed overhead here of $50 per hour. Okay, so and you can look at it in these terms too here. If you weren't given all of these items, you would just take if you knew where your total fixed cost would be for the period. Again, we're going to estimate that at $240,000 worth of total fixed cost, and then divide it by, again, your total direct labor hours that we're estimating, those 4,800 hours. So that's going to give us a budgeted fixed overhead rate here of $50 per hour. Okay, so that's how you would go about determining your indirect costs here. We looked at the variable component and the fixed component. And what we want to come up with, well, we broke it out here. We had that variable component, and we can go look at that here one more time, where our variable overhead was sitting here at $30 per hour. So for every direct labor hour, $30 per hour here is going to be charged against your total variable overhead. And then moving back down here to our fixed overhead, that was sitting at $50 per hour. So our total overhead rate on a per direct labor hour is our variable overhead here rate of $30 per hour plus our fixed overhead rate here of $50 per hour for a total amount here of $80 per hour. So that's what you would be applying here based on your budgeted amounts here. Okay, so just remember there's a variable component and a fixed component that we went through. And we looked at just typical items here that would be included in both the fixed and variable components, and then you could break it out here where you do a calculation to determine how much each one of those components here is contributing to the indirect cost that we're looking at, and how they would be charged off for against each direct labor hour. Okay, so that's how you would go about doing that. Now let's go back over here. Now we're going to just look at how we would, moving over to our manufacturing overhead control account. Okay, we've figured out what's sitting in here, what components and our budgeted amounts, what would be sitting in our manufacturing overhead control. Well, we don't know what's exactly sitting in here at that. We only know at the end of the period we're going to come up with some actual indirect costs, which would be those all for our variable overhead here and our fixed overhead. Whatever those items are, we're going to have come up with our actual cost. But what we're going to do is we're going to charge off during the period here. We're going to use that applied overhead rate here. So as those jobs go through the factory, we can apply the overhead rate to them, and we know the cost at the time that we make that applied amount. So we can work with our costs that. Otherwise, with our actual amount, we have to wait till the end of the period to determine what's actually coming in here. And using the applied amount, we can credit it out our manufacturing overhead account, and those were based on those calculations we made, and then it would go into the work in process account here. And you debit or increase your work in process account, and then as this material, as this inventory here is being it would go into as we complete the jobs here, they would go into finished goods category, but it would go in as a cost of goods manufacturing. Whatever we're sitting in our work in process here, whatever we're moving out of our work in process would go into a cost of goods manufactured, and then it's going to go back into a cost of goods sold. But this is what, let's look at how we would apply this manufacturing overhead rate to our work in process. Okay, again, going through working off our three accounts here. We're going to have those miscellaneous accounts, and really that's what we looked at for our calculations here. It would be that fixed and variable overhead components. Those are all, when I say miscellaneous accounts, those are all those different items that we looked at under the variable overhead here and our fixed overhead, those different components. But what I'm showing here is for our credit, what's sitting in our miscellaneous, where we're going to credit out here for our, and that's what would be going into our manufacturing overhead control account here, would be the actual overhead costs. So those variable components that all those variable costs that we have for the period are sitting at $121,500, and then our fixed components, those are at $242,500. So our total amount here in our fixed and variable overheads that we have for the period here, the actual overhead cost is $364,000. Now, what goes into our manufacturing overhead here, and we're going to look at it based on our budgeted amounts and actual usage here. So for our manufacturing overhead, we would have our total fixed overhead plus our total variable overhead. So for what we would do here for this job order costing, we take the budgeted fixed amount plus our actual variable amount. So for our budgeted fixed amount, we had that fixed overhead rate here, $50 per hour, times, we would put the denominator hours, or total direct labor hours here, that we budgeted here at 4,800 hours. So that 50 times our $50 rate here times 4,800 hours is going to give us $240,000 here worth of budgeted fixed overhead. But the other component would be the actual variable amount here. And really that's taking those actual hours that we use for the period here times our variable overhead rate. And in this case, the actual hours that were used here in direct labor hours here for the period were 4,100 hours. Variable overhead rate, we had that budgeted amount here of $30 per hour we calculated. So that would give us $123,000 here. So our actual variable is $123,000. Add to it our budgeted fixed here, $240,000. So what's coming into our manufacturing overhead control account here, and from those miscellaneous accounts, those indirect labor, indirect material here, is $363,000 based on our budgeted and our actual usage, budgeted fixed and our actual variable here, based on those hours, those actual hours that we have. So what would be going out? What would we be applying here to our work in process? And in this case, we got the $363,000 here that went into our what we came into our manufacturing overhead control account here, but what's going to go out here is $328,000, and that's going to be on how we apply it. So we're just simply doing this. You just take your variable overhead rate here, $30 per hour, plus your fixed overhead rate here at $50 per hour, total them together, take them times the actual hours used, or direct labor hours used, 4,100 hours here. So that's going to give you $328,000. So now we have a variance here between our actual overhead, our actual overhead costs here for the period. Those are the actual amounts. Those weren't based on those budgeted amounts. Those are totaled up actual amounts here. $364,000 versus our work in process here at $328,000. So what that's going to amount to is really a spending and idle capacity variances. We're not going to get into those calculations, but I'm just pointing that out. So those have to be accounted for, and you would account for those because you have to correct your accounts in your books here. So you got to really come up with taking your actual versus whatever your actual overhead cost here versus what you applied here, and you have to adjust your books, and that's a whole another topic here. But it goes into, again, those variances here. So, and then we have one other variance here. Let's point them out. The $364,000 here, that for our actual overhead costs here, variable and fixed, compared to what we brought in here, budgeted and actual variable here, $363,000. There's only $1,000 difference here, and that's going to be what they call a spending variance. Again, we won't get into the calculations, but nonetheless, we have to account for the difference here between this $328,000 here versus the $363,000. That is what we call idle capacity variance, had I not mentioned that. That's only because we budgeted 4,800 direct labor hours and we only use 4,100. So that is called idle capacity variance. We won't get into all of those. But the point is here, I just wanted to go through this here to understand this manufacturing overhead control account and what's coming into it here, and versus our actual costs here, and then what's going out of this, how we are applying or how we charging off all this overhead cost to our work in process account here. So you can see the applied one here was based on those budgeted variable overhead rate we had for the period plus our fixed overhead rate times the actual hours used here. Okay, so I guess that pretty much just ends our discussion here, but just to give you an understanding, the big thing here was to look at that fixed and variable overhead, how we calculated it, and maybe let's just go back here one more time. Okay, again, our variable overhead, showing those amounts here, you're going to figure out on a per component basis here how much each one of those components would be contributing towards the indirect cost here, variable overhead. Come up with a total amount here based on those individual components, and you can look at it in terms of the total amount too. You just take your total variable cost, again divide it by your total. In this case we're using direct labor hours as our basis here, and whatever that is, it's coming up with the total variable overhead on a per direct labor hour that you'd have to be charging off. And then just moving down to our fixed overhead, again showing the items here. They're not all inclusive. Changes. There's a lot of other different fixed and variable overhead components. I'm just showing the main ones here and how you do it. Again, come on for each one of those components, you can figure out how much each one is being charged off, would have to be charged off for those, for the indirect costs here. Both in this case, we're looking at the fixed overhead, indirect costs here. Figure out on a component basis, and then you just total them up here, and then you take your total fixed overhead here. Okay, and again, you can figure it based on just your total fixed costs for the period. Again, these are all budgeted in your total direct labor hours here. So what we went over in both cases here for our variable overhead here and our fixed overhead was based on a budgeted amount here. And then we use that budgeted fixed overhead rate here and our variable overhead rate here for applying our overhead costs to our inventory, our work in process. And again, those were based on budgeted amounts. But then we had to, at the end, we'd know our actual overhead costs for the period for those jobs, and then we'd have to make corrections. to adjust our accounting records such that we have to bring everything back into our actual usage or actual overhead. Okay, so that'll summarize our topic.